I'm Kim Brimmer, your host today for another edition of Bova News, keeping you up to date on the cattle industry's latest in technology, management, genetics, and more. Dairy producers are in the midst of another unique financial situation, with high milk prices coupled with high feed costs. There are a number of domestic and global issues that have led to this current situation, and it appears that this volatility will continue for some time. Today, we'll hear from risk management professionals to tell us how we got to where we are today and what the future holds in terms of making sense of the current dairy market. Jim Matthews is the Global Grain and Feed Director at ever.ag, managing the Feed Foundation's program alongside ever.ag's grain and dairy producer teams. Jim's career in the grain, futures, and options industry includes exchange and clearing services, in addition to risk management for merchants, end users, and producers. Presenting with Jim will be Jake Kingsley, ever.ag's Director of Feed Procurement. Jake started his professional career as a grain merchant in Tulsa, Oklahoma. While there, he originated grain from both producers and commercials across Kansas and Oklahoma into rail and barge terminals for Consolidated Grain and Barge. After 3 years in Tulsa, he took a job as a feed commodities merchandiser with Livestock Nutrition Center in Saginaw, Texas, where he worked with dairies and corn producers across Texas. Welcome, Jim and Jake.
Hello, I'm Jake Kingsley, and as Kim said, I'm here with Jim Matthews today. And we are the feed risk management team for dairy producers across the U.S., coming to you from ever.ag. You may know some of our subsidiaries, CRMG, Rice Dairy, Blimling, or Dairy.com. We are all now under one umbrella as ever.ag. So let's get right into some feed pricing here this morning. I think the first thing to break down is what goes into a cash feed price. We get a lot of questions about that from folks that are new to risk management. And it's important to know that for your corn, soybean meal, canola, some other soy derivatives, and some other corn products, you have a cash price that's based on A, the futures market, and B, a basis for your local vendors. And those two components can be separated to create some flexibility in your pricing. And when they're put together, they create your cash feed price that you pay the mill. So what is the CBOT and the futures contract piece of your price? It's just a global benchmark for commodities prices. So when you look at corn futures, everybody around the globe is speaking the same language and talking about the same numbers. That's the piece that allows you to truly manage your risk utilizing futures and options on the exchange. And so you can take that piece and put together strategies to limit the highs in the market that you're going to pay on your feed, or make yourself accessible to moves lower on feed you've already purchased. And then you pair that together with what we call basis, which is a more localized piece of your price. It comes down to supply and demand in your backyard, the freight to get it there, what your market is having to do to compete with exports or destination rail markets, or if you're in a rail market, what rail freight and fuel is costing to get out there, the margin that the mill puts on it to produce a refined commodity. All of those things go into your basis. And so you have those two pieces, and you're able to manage them independently to get the best value for your feed price. Because oftentimes when basis is a better value, futures may not be quite as favorable for your pricing, and vice versa. So if you can separate the two and work them independently, you can try to get the best value for your feed as you buy it throughout the year. So let's look a little bit at the basis market here. Jim and I work as experts on those independent pieces. I cover basis as well as cash markets, and Jim works the futures side, helping manage the risk on that for our dairy producers. And so I'll dive a little bit into basis here. As you are probably well aware already, basis has been higher over the last few years than it had been for probably a 4 or 5 year stretch there, where things were pretty quiet. And so what you're seeing here are some basis values coming out of the Midwest. Use Central Illinois as kind of just a hub for national basis trends here. You can see that corn was fairly elevated and then made a very strong jump as we led towards harvest last summer. And that was largely on the back of higher freight costs and uh, dry weather conditions, planting concerns, and a fear that we were going to have a smaller balance sheet than expected leading towards harvest. Farmers had a lot of corn tucked away in the bins and were a little reluctant to let go of it. They had some pretty good crop years 2 years prior with some good prices, so they could afford to hold out a little bit longer. And then we saw a pretty strong break as we got into harvest. Saw some of our lows of the year right there at harvest, and then it trended back up just a touch, which amounts to about $5, $10 a ton out of the Midwest. We see soybean meal over the last year has been a little bit more volatile in the basis realm, but overall has trended up as well. And so the things that are going into that primarily here in the US are that we have thinner than we would like balance sheets, meaning we have less corn left over at the end of the year and less soybean meal left over at the end of the year than you would say in maybe a normal year. So supply and demand has affected that. And you get some regionality to that as well. Our folks in California and the Texas markets are seeing a much greater increase in their corn basis and a much stronger uptrend in their protein basis because they are also dealing with a pretty strong spike in rail freight values. So we are working through a lot of that here for old crop. It's kind of tough to find some opportunities in that piece of the market because we're just short on time. But we are seeing some new crop numbers break down a little bit and get to be more favorable than what we've seen in the last year. So we may be coming up on some activity in the new crop basis realm here for both corn and proteins. I talked about how the rail markets had been pretty strong. That's running right along with crude oil, really. It's a two-part piece from crude. Prices have spiked, and so fuel costs have gone up dramatically. That's the first piece. And then secondly, we banned imports of Russian oil, which means that now we have to shuffle oil around the country into places that typically maybe was coming in from a seaport or from some other access point. Now it's coming from domestic production or new import locations and being shuffled to those places that need it the most. And so you're seeing capacity for rail cars being taken up by more oil than normal. And so that makes grains and other commodities have to compete for that transportation ability. Another piece that has run basis here a little bit over the last year has been ethanol demand. Again, that's tied right back to the oil market. Good oil prices have allowed for ethanol to run at a higher value and be blended off into gasoline at a higher price. And so ethanol plants are able to make modest margins. They had really strong margins over the winter months from November to January. They had some $1.50 margins when they normally run closer to 30 cents a gallon. And so they consumed a lot more corn then. And again, with this Russian oil ban and high gasoline prices, the government normally allows a 15% blend of ethanol into gasoline over the winter months. And then in the summer, that's cut back to 10% in order to kind of relieve prices and keep the pipeline flowing. They are looking at opening up to 15% blend in the summer months versus the normal 10%. And that's going to put additional pressure on this corn market as our feed markets are going to have to compete with ethanol plants to get more corn moving in a typically out of season time frame now. Additionally, on the protein side, we had a very lackluster canola crop in Canada last year. They produce about 90% of the world's canola. They had a very severe drought and lost more than a third of their expected production by the time harvest came through. And so we've had to have export markets displace canola by feeding more soybean meal or other protein alternatives. Feeders out west that rely pretty heavily on canola switched over to soybean meal. And so you're seeing with that lack of production out of Canada, protein basis was stronger. Now they're expected to come back in with futures the way they are and prices the way they are. We're expecting the canola crop to bounce back. Acres should be as good as any time. It all comes down to weather there this summer. Are they going to have another drought? Are they going to start to get some rains to relieve some of that and get production back on track? If they can do that, we're already seeing some decent basis values in both canola and soybean meal. But if they get a good crop off in Canada this summer, we could see those numbers sink down a little lower yet, and maybe get some pretty average basis numbers knocked out. So that's a quick breakdown of what's going on in the basis market today. Like I said, Jim's our expert on the futures side of your cash price, so I'm going to turn it over to him to kind of break down the rest of the feed market here.
Good deal. Thank you, Jake. And thank you, Kim, and the Bova News crowd. Very much appreciate you guys having us on. And for Jake to label me an expert might be a stretch, but we'll try our best here. Jake touched on a few of the supportive factors that have been affecting our markets, specifically the basis market, but also he did dive into a few items affecting corn in particular, one of those being ethanol demand and consumption. So as we note on the slide here, we do have a long list of bullish factors at work for your corn markets. We've broken down on the screen July and December corn. And for those of you working with a dairy operation, we utilize the July corn futures contract as a focus on maybe the rest of this crop year. So now through September, any pricing on corn procurement is most likely utilized at this time through the July futures, whereas anything October forward and into the next calendar year or the new crop year, we're utilizing December futures. So we wanted to provide both charts for you and show that we are at near record highs. We have not quite tested them yet, but the fact that we are towards the end of April and we are pushing July corn futures at and above $8 a bushel, and your December corn futures at $7.50 per bushel is quite notable. We rarely get to levels this significantly high. So again, the long list of factors at work include the obvious Ukrainian situation and the Russian invasion there, and the time will tell aspect of how many Ukrainian farmers can get into the fields. There's a variety of factors at work. Obviously, safety is a huge concern, but even those that are in relatively safe areas of Ukraine, can they afford to get in the field? Can they afford fuel, labor, parts, seeds, et cetera? So we have that Ukrainian corn production chart at the bottom left of the screen. They've become a very notable player in terms of production and export. So to lose their corn production and corn supply globally is one of the key reasons we've seen prices elevated. The other is the top left chart there of prospective plantings. At the end of March, the US government provided us their projected acreage for this calendar year, as corn being notably lower than the market expected and actually lower than the projected bean acreage, which we never see in the United States. Corn always outplants soybeans here. So with those two factors, we are projecting lower ending stocks than anticipated, especially for the amount that the world consumes. And we utilize those stocks to use ratio charts you see on the screen. So we have Ukrainian production concerns, lower USDA acreage. U.S. exports have been at quite the pace despite the strong U.S. dollar, which is something we need to keep in mind. Ethanol usage continues to run hot, and as Jake noted, could continue to increase this summer with revised blending mandates. We have high input costs ranging from labor to fertilizer issues and fuel. And then wheat prices, along with the Ukrainian situation, have been elevated as well. And as a substitute, corn has rallied with it. Meal prices are also strong. They've come off a little bit in the last month, at least relatively to corn. We've had the meal market take a breather at the Board of Trade. But again, we show you the July and December meal market to get a feel for where your protein might cost at the board. Not at the record highs that we look like we're testing for corn, but we are up there and remain elevated on both of those futures markets. Similar to the corn market, it's been a very global story for meal. We've had the South American soybean production concerns out of Argentina and Brazil in terms of weather issues affecting them this winter, at least our northern hemisphere winter, and reducing yields there. And the USDA has routinely reduced total soybean production out of both of those countries, Brazil and Argentina. And those are large players in the production and crushing of soybeans. So we're keeping a sharp eye on those two countries, but their yield issues are another reason why we've seen soybeans elevated, and therefore soybean meal, the key byproduct of crushing soybeans in terms of feed usage, has been elevated as well. We're keeping an eye on the prospective plantings for soybeans because those were much higher than anticipated in the end of March government report. Naturally, more soybeans available might mean more to crush, and the more we crush could put some pressure on the meal market, but only if, of course, demand stays unchanged, and we've seen demand remain strong in that regard. The Ukrainian situation has mostly been a corn and wheat story for most, but it's important to keep in mind that Ukraine is a significant sunflower and sun oil producer. So they also play a role in the oil seed industry, and soybean oil being a substitute for sun oil, and of course, soybean meal for sun meal. We need to see just how much acreage and production we might lose from the Ukrainian sun crop. This, of course, has led to increased volatility at the Chicago Board of Trade in both your corn and soybean meal markets. Not quite what we had last summer for the corn market, but certainly elevated, whereas meal really started to take off in terms of its volatility towards the end of last calendar year, and remains elevated at the moment. Again, although both of those have come off a little bit, you can see them plateauing somewhat on each of these charts. It does remain relatively elevated overall. Jake pointed out the elements of pricing your total feed cost and how basis and futures kind of play that 1-2 punch. We utilize a calculator here in-house that helps you determine not just a conversion of bushels to tonnage for your corn, because many of your feed mills and vendors offer those pricing and contracts in tons, whereas the Chicago Board of Trade prices you in cents per bushel. But it's also important for us to then utilize in-house, how can we take what a soybean meal or corn vendor or mill might be offering you and convert that into just how much are we gaining or losing in basis at the Chicago Board of Trade. And of course, what can we do to manage that risk? We utilize the Board of Trade futures and options market to hedge your one element of the pricing risk with your mill. And that dives into what strategies can we use to help maintain some flexibility if you can get an offer. And Jake noted this as well, that there are certain areas of the country where meal and corn are just extremely tight, and your vendor or mill might not be offering you what we refer to as the new crop contract because of availability and pricing concerns there. So we have our Feed Foundations program here, where we monitor where do we have risk in which particular feed market, where are we in the country that might affect that supply or availability, how many vendors might be in that area, and what tools can we use in the tool belt to make some adjustments and maintain flexibility in your feed procurement and purchasing plans. With that, I think I will turn it back over to Kim. Thank you very much for your time.
Thank you, Jim and Jake. If producers haven't locked in feed prices for 2022, and I know Jim and Jake, you did a great job walking us through cash and basis and futures, are we too late to be locking in feed prices for that of 2022? Is it too early to be thinking about 2023? Where are you on your crystal ball?
I don't think it's ever too late to start managing your risk on your feed. It's definitely more expensive now, but milk prices have moved up as well, so you can still be profitable. So it's going to be more difficult to get what you want out of the 2022 crop, but it can be done. And then as far as new crop, no, we're not too early at all. There's some opportunities on the table. and Jim could speak a little bit to the opportunities we're seeing specifically in futures. Um, it's a little bit tough on the basis side of that. The logistical uncertainties and rail cost and fuel prices and just the unknowns of this coming crop year have folks fairly hesitant to go out and offer much in the way of basis contracts. And if they do, they're pretty elevated, got a lot of risk premium built into those. There have been a few blips in the market where you could get something fairly decent done earlier on this year. We might be coming towards somewhat of an opportunity in the protein market here now. But as far as managing risk on new crop, I think, Jim, you could talk a little bit about what can be done on futures there.
Certainly, and as Jake noted, I mean, for old crop from now through September, certainly not too late. And there's a lot of time here to either have a beneficial or detrimental planting season here in the U.S., which immediately impacts the new crop pricing, but could really start to squeeze that old crop pricing if we feel that this is the last of available supplies on hand, depending on the planting and early development season. And also our exports could continue to accelerate here as we see poor yield reports continue to come out of South America. So it is not too late to go ahead and try and at least cover some of your old crop exposure from now through September, primarily utilizing the July futures contracts as we showed in our presentation. And in terms of new crop, never too early. And it's just a matter of, as Jake noted, are your mills or vendors even offering a new crop contract at this point? Many are not, especially from our participants here on the webinar that might be out west. We're having a lot of difficulty in that availability as we've discussed here today. But you can always utilize the exchange, at least attempt to put some sort of risk management strategy to cover those December underlying futures, so that when you finally are able to at least secure a new crop contract, at least you've had some sort of risk management done at the board.
My thanks to all of you today, Jim, Jake, for joining us and sharing your invaluable expertise and experience. Don't forget to subscribe to the Bova News channel on YouTube, find our Bova News podcast on your favorite listening platform, or find more information at bovanews.com. Thanks for tuning in with us today, and we'll see you next time on another edition of Bova News.